The average speculator believes a market correction is a store-wide sale. He sees prices slashed across the board and rushes in like a bargain hunter, eager to buy yesterday's favorites at a supposed discount. He looks for the stock that has fallen the most, thinking its path back to the top is the longest and therefore the most profitable. This single catastrophic error in judgment is the primary reason most accounts are destined for ruin. The professional operator, by contrast, understands that a correction is not a sale. It is a crucible. It is a period of intense testing where the market's true character is revealed. It is the time when the future leaders separate themselves from the future laggards, and the intelligent speculator's only job is to sit quietly and observe which is which. You must understand that the public is almost always driven by price, while the professional is driven by behavior. The amateur sees a stock that was once $150 now trading at $75 and concludes it is cheap. The professional sees the same stock and understands that its 50% collapse, while the general market only fell 10%, is a screaming signal of profound internal weakness. It is not cheap, it is damaged. Something is fundamentally wrong with the company, its industry, or the opinion of the men who know it best. To buy such a stock is not speculation. It is a blind gamble on resuscitation. It is betting on the weakest horse in the race simply because it has fallen the furthest behind. This is a strategy for the poorhouse. My own education in this matter was brutal and expensive. In my early days, I too was tempted by the allure of a beaten-down stock. I would see a name that had been a market darling fall from grace and think, it must come back. I would buy it, and more often than not it would continue to sag, tying up my capital and my mental energy while other, stronger stocks began new advances. It was only after repeatedly watching my capital stagnate in these sick companies that I learned the great secret of market leadership. The secret is not to find the stock that has fallen the most, but to find the stock that has refused to fall at all. I can recall countless instances, sitting alone in my office with no sound but the clicking of the ticker, the stream of prices that was the ancestor of your modern real-time data feed. The general market would be in a state of panic. U.S. Steel, Bethlehem Steel, the railroads, all the great bellwethers of the day, would be cascading downwards point after point. The air would be thick with fear. Amid this financial carnage, one stock would catch my eye. It would trade within a fractional range. While the market was down 5 points, this stock might open down an eighth, trade back to unchanged, and then close up a quarter. It stood like a stone wall against a tidal wave of selling. The inexperienced man looks at this and sees nothing. He is focused on the more dramatic declines. But the seasoned operator sees everything. This is not a random occurrence. It is the most significant piece of information the market can provide. It is the footprint of a great power at work. The stock's refusal to decline is evidence of a large, persistent, and intelligent buyer who is absorbing every share the panicked public can throw at him. This buyer is not guessing. He knows the company's true value. He is using the market's temporary insanity as a golden opportunity to accumulate a massive line of stock from weak hands without disturbing the price. He is not supporting the stock to be a philanthropist. He is accumulating it because he has positive information that it is destined to sell at a much higher price. This stock, the one that holds firm in a storm, is the one that will lead the charge when the storm passes. It has been fortified. The ownership has been transferred from fearful hands to strong, confident ones. The path of least resistance has been cleared for a major upward move. Jesse Livermore consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. Applying this principle today is simpler than ever before. You have tools of analysis at your fingertips that I could only have dreamed of, yet the human emotions that drive the market remain unchanged, and so the principle of relative strength is as immutable as gravity. When the S&P 500 or the Nasdaq begins a general correction, your work begins. You must cease all offensive operations. Your capital should be primarily in cash. Your role shifts from that of a soldier to that of a general on a hilltop, surveying the entire battlefield. You are not there to fight. You are there to identify which regiments hold their ground under enemy fire. Your first step is to consult the list of stocks that were the undisputed leaders of the previous bull market. These were the companies with the strongest earnings, the most innovative products, and the most powerful price momentum. These are your proven champions. You do not waste your time searching for some obscure, beaten-down name in the hopes of finding a hidden gem. You focus exclusively on the known quality, the established generals of the market. Your goal is to see which of these generals still has fight left in him. As the market index, your SPY or QQQ, sells off day after day, you methodically track the behavior of each of your chosen leaders against it. You can do this with a simple percentage calculation or a relative strength line on your chart. You will find they sort themselves into three distinct categories. The first and largest category will be the fallen angels. These are the former leaders that break down and fall just as fast, or faster than the general market. Their leadership has ended. Whatever magic they possessed is gone. They are now common soldiers, and you must strike them from your list immediately. They are of no further interest to you. The second category is the common stock. These companies fall in lockstep with the market averages. They go down when the market goes down, and they bounce when the market bounces. They are neither leaders nor laggards. They are simply part of the herd. You may keep them on a secondary list, but they are not your primary targets. They possess no special strength. The third category is the smallest, the most precious, and the only one that matters. These are the true leaders. While the market index is down 8%, 10%, or 12%, these few exceptional stocks will exhibit astounding resilience. Perhaps they only decline 2% or 3%. Even better, perhaps they trade sideways in a tight, orderly consolidation, refusing to give up any ground at all. They are building a flat base on your chart while the rest of the world is carving out a valley. This is not just a pattern on a screen. It is a portrait of supply and demand. It is the visual evidence that for every seller motivated by fear, there is a large, determined buyer willing to meet them, absorbing their shares and putting a floor under the price. This stock is screaming at you, "I am the one." It is demonstrating its superiority in the most challenging environment possible. This is the stock you must prepare to buy. When the general market finally shows definitive signs of bottoming and begins its turn back upwards, you do not have to guess what to buy. The market has already told you. Your period of observation has provided you with a short list of 1 to 3 names that have proven their mettle. You do not buy the index ETF. You do not buy the fallen angel, hoping for a rebound. You concentrate your fire on the true leader. You wait for it to break out from its flat base on an increase in volume, your pivot point, and you establish your initial position. This stock, having absorbed all the selling pressure and shaken out all the weak holders, now has a clear path upward. It will often move faster and further than any other stock on the market because its journey is not burdened by the overhead supply of trapped holders waiting to sell at break-even. Let me be unequivocally clear about the danger of ignoring this principle and instead buying the laggard. The stock that drops 50% when the market drops 10% is broadcasting a message of extreme sickness. The bargain hunter sees a discount, The professional sees a terminal diagnosis. This stock is weighted down by a massive amount of overhead supply. Every person who bought it on the way down is now trapped at a higher price. They are not hopeful investors. They are desperate prisoners. Their one and only thought is, please let it rally so I can get out at what I paid for it. On any small bounce, this army of trapped holders will begin to sell, creating a constant ceiling of resistance that smothers the stock's ability to advance. Buying this stock is like trying to run a race with an anchor chained to your leg. You will exhaust your capital and your patience, going nowhere, while the true leaders are sprinting towards new highs. The market does not owe anyone a recovery. A stock that has been fundamentally impaired may never return to its former highs. To buy it is to place your capital in a prison of hope, and hope is a speculator's greatest enemy. It is a financial anesthetic that numbs you to the pain of a continually losing position. You must amputate hope from your trading psychology and replace it with observation and reaction. Observe what the market is actually doing, not what you hope it will do. The market is the ultimate arbiter of truth. When it tells you a stock is weak, you must believe it. When it tells you a stock is strong, you must believe that as well. Relative strength is the market's own language for communicating this truth. Therefore, the rules for profiting from market corrections are simple and absolute. They are not guidelines. They are laws. To violate them is to court financial disaster. First, when the general market trend turns decisively down, your offensive campaign is over. The time for aggressive buying has passed. Your primary duty is the preservation of capital. Move to the sidelines. Your main position must be cash. A speculator without cash is a carpenter without tools. He is out of business. Second, your new occupation during the correction is that of a market detective. Your sole objective is to identify the next leader. This is not done by reading reports or listening to opinions. It is done by watching the tape, by observing the price and volume action of the leading candidates. Third, you will maintain a concise list of the most powerful stocks from the prior uptrend. Do not add new, unproven names. You are interested in how the reigning champions behave under pressure, not in auditioning unproven contenders. Fourth, as the correction unfolds, you will scientifically measure the performance of each candidate against the market index. The one that falls the least or holds flat is demonstrating its inherent strength and the presence of intelligent accumulation. This is your prime target. Fifth, when the market confirms its uptrend has resumed, you will act decisively. You will buy this demonstrated leader as it emerges from its price consolidation at a proper pivot point. You must act without hesitation. The period of patience is over. The time for courage has arrived. Sixth, you will, under every circumstance, resist the temptation to buy the laggard. The stock that has been crushed the most is not a bargain. It is a warning. Its weakness is a fact, not an opportunity. To buy it is to volunteer for a long and painful lesson in the high cost of cheap stocks. Let other men populate the sick bay. Your place is on the field with the strongest soldiers. By following this method, you align yourself with the market's most powerful forces. You are not guessing. You are not hoping. You are acting on the clear evidence the market itself has provided.